What if I told you that silver is no longer behaving like it did over the last 10 years? What if the calm, slow-moving silver market is already gone, replaced by something far more explosive, far more volatile, and far more powerful? We are now seeing $100 moves in a single day, sometimes even $200 swings. That is not normal. That is not typical behavior. Something bigger is happening. Welcome to Gold Silver Scope, where we break down gold and silver markets in simple, clear language so you can understand what truly matters. Over the past decade, silver was mostly quiet. It moved slowly. It respected historical ranges. But now, volatility is off the charts. These massive daily swings are a sign that the structure of the market is changing. And when structure changes, opportunity follows. Think of the global financial system like a long line of dominoes. Some are small, some are massive. All of them are connected. When one begins to lean, pressure transfers to the next. What we are witnessing in the metals market today could be the first major domino starting to tilt. For over a year, analysts have discussed a major transition: the shift from paper markets controlling prices to physical markets taking control. Most people do not understand this difference. Spot gold and silver prices that move rapidly are paper contracts, futures, options, swaps. They are not physical bars moving between vaults. Physical markets do not move $100 in one day. Paper contracts do. Silver is unique because it lives in two worlds. It is both an industrial metal and a monetary metal. Most investors today think of silver mainly as industrial. But historically, silver has been money for thousands of years, just like gold. That monetary identity may be waking up again. History shows us something very important. Silver does not move slowly during bull markets. It explodes. In 1980, silver surged from single digits to $50 in just months. That was an extraordinary move. Then in 2010-2011, silver doubled in about 7 months during another powerful surge. These were not normal rallies. They were bursts, explosive bursts. Both of those historic moves were triggered by silver outperforming gold. When silver begins to rise faster than gold, it signals a major shift in relative strength. That breakout structure is appearing again today, after a decade-long base. But here's the key difference. Today's volatility is even greater. We are already seeing price behavior that is far more aggressive than the last 10 years. That tells us we are not in a normal environment. We are entering a high-energy phase. And here is something even more important. In the past, those explosive rallies happened within an old pricing range. Today, that old range may no longer apply. The old reality could be gone. The question is not whether silver will move. The question is, how high will it define the upper boundary of this new reality? Could it overshoot dramatically? Possibly. Silver has a history of overshooting and then correcting sharply. But the real question for investors is timing. Did you enter at the right moment? Short-term momentum indicators are already showing buy triggers. Daily momentum has crossed upward. Weekly momentum is close to confirming strength. Even on smaller time frames, silver is signaling that it is climbing out of a correction phase. Nothing fundamental has broken. What changed recently was sentiment. Public emotion shifted. Fear replaced excitement. But structurally, the trend remains intact. When silver pulled back in the past, especially during major bull cycles, those pullbacks often became powerful buying opportunities. Investors who waited for perfect conditions usually missed the move. Now compare this with other markets. While precious metals strengthen structurally, cryptocurrencies are facing severe stress. Bitcoin recently failed near the $107,000 level and collapsed towards $60,000. Ethereum has dropped even harder, revisiting price levels seen years ago. Many late buyers are now underwater. This matters because for years, crypto was presented as digital gold, but under pressure, that narrative is being tested. When leveraged speculation unwinds, it rarely stays contained. Financial stress spreads. Companies exposed to crypto could face consequences. Losses in one asset class often create ripple effects elsewhere. Meanwhile, central banks around the world continue accumulating physical gold at record levels. That tells us something. Smart money is not abandoning metals. It is increasing exposure. Silver, being smaller and more volatile than gold, acts like a pressure valve. When stress builds in the financial system, silver reacts faster and more violently. That volatility we are seeing may not be random. It may be signaling deeper structural instability in leveraged paper markets. The key issue is leverage. Paper contracts represent promises, often far exceeding the amount of actual physical metal available. When leverage becomes extreme, the system becomes fragile. If large short positions are built without physical backing, instability grows. This is not about physical bars disappearing. It is about layers of leverage promises stacked on top of each other. Gold itself is trading far above its long-term moving averages. That does not automatically mean it is overvalued, but it does show tension. Nothing rises vertically forever. Markets must consolidate or correct to reset technical conditions. However, when gold stretches far above trend lines, it often reflects instability in leveraged paper markets, not just strong physical demand. This is why volatility has increased. The dominoes are beginning to lean. Now let's go deeper into what is really happening beneath the surface. Most investors think metals move because of supply and demand for physical bars. But in today's financial system, the visible price of gold and silver is mostly determined in the paper markets. These include futures contracts, options, swaps, and unallocated accounts. These are leveraged instruments. They are promises, not physical metal. And leverage changes everything. Leverage means controlling a large position with a small amount of actual capital. It is like building a tall tower with a very small foundation. As long as conditions are calm, the tower stands. But when volatility increases, the tower begins to sway. That is what we are seeing now. When silver moves $100 or $200 in a single day, that is not physical supplies suddenly disappearing. Mines do not shut down overnight. Vaults do not empty in 24 hours. Those massive swings are happening in leveraged contracts. This is why the transition from paper control to physical control is so important. For years, price discovery has happened primarily in paper markets. Large traders could influence price direction with massive contract positions. But when leverage grows too large compared to real metal underneath, fragility increases. If a major trader builds an extremely large short position, especially a naked short position without physical backing, the risk is enormous. A short seller is betting that price will fall. They sell something they do not own, hoping to buy it back later at a lower price. But if price rises instead, losses can grow very quickly. When these short positions become oversized, they do not just threaten one trader. They threaten counterparties, clearing systems, and sometimes even governments. And here is where things become serious. If authorities step in to stabilize a position, that tells you the exposure was large enough to create systemic concern. Governments do not intervene in small trades. Intervention signals stress at a structural level. This is not about a few ounces of silver moving between vaults. This is about massive leveraged promises that could destabilize the broader system. Silver sits at the center of this tension. Because silver is smaller than gold, it reacts faster. It is more volatile. It straddles both the industrial world and the monetary world. That dual identity makes it sensitive to economic slowdowns and monetary anxiety at the same time. When industrial demand weakens, silver can fall sharply, but when monetary fear rises, silver can explode upward even faster than gold. Right now, we are seeing extreme volatility because these forces are colliding. At the same time, Gold is trading far above its long-term averages. The distance from the 200-day moving average is unusually large. That kind of divergence rarely lasts forever. Markets must eventually pause, correct, or move sideways to allow technical measures to catch up. But here is something important. Being far above a moving average does not automatically mean a crash is coming. It means instability is present. There is a difference. Instability often comes from leverage. When markets stretch too far above trend lines, it can signal that paper contracts are driving price aggressively. The physical market does not move in straight vertical lines. Leveraged contracts can. And remember something critical. Years ago, estimates suggested that for every single ounce of physical gold, there were tens of thousands of ounces represented in digital or synthetic form. Whether the exact number has changed or not, the principle remains the same. Paper exposure far exceeds physical metal. That imbalance creates tension. If confidence in paper claims weakens, even slightly, investors may shift toward physical ownership. And if that shift accelerates, the paper side becomes vulnerable. Now let's connect this to broader financial markets. We have already seen stress in cryptocurrencies. When speculative assets begin collapsing, leverage unwinds. When leverage unwinds, liquidity tightens. And when liquidity tightens, investors look for safety. Historically, gold benefits first, then silver follows, and often outperforms. But silver does not move gently. It moves in bursts. It surges rapidly, often overshoots, and then corrects violently. That is its nature. So when we say silver could define a new upper range quickly, possibly within months, not years, that is based on historical behavior. When silver breaks out of a long base relative to gold, it tends to accelerate. We saw that in 1980. We saw that in 2010, 2011. Now we are seeing a similar relative breakout structure forming again after a long consolidation. The difference today is the size of global debt, the level of monetary expansion, and the scale of leverage in financial markets. The system is larger. The dominoes are bigger. If one major domino falls, it does not fall alone. Gold futures are one of the largest paper markets in the world. If instability spreads from silver contracts into gold contracts, volatility could increase dramatically. Again, not because vaults are empty, but because leverage is wobbling. This is why recent price action feels different. It is not just another rally. It feels like structural pressure building beneath the surface. However, we must stay balanced. Nothing goes straight up forever. Even in powerful bull markets, corrections happen. Consolidations happen. Sideways movement allows technical conditions to reset. Markets can remain irrational longer than expected, but the larger trend may still be intact. Silver's volatility is not a weakness. It is a characteristic. It is the fuse. When momentum turns positive after a correction, those who understand its nature see pullbacks as opportunities, not as breakdowns. The key question is not whether volatility exists. The key question is, what is causing it? If volatility is coming from structural stress in leveraged paper markets, then silver's explosive potential remains alive. Now let's connect all the pieces. We have rising volatility in silver. We have gold stretched far above long-term trend lines. We have leverage stacked heavily inside paper markets. We have stress spreading from speculative assets into broader financial systems. This is not random noise. These are signals. Think again about the domino line. At first, all dominoes stand upright. They look stable. But when one begins to lean, pressure transfers quietly. Most people do not notice until the movement becomes obvious. By then, the chain reaction has already started. Silver is often the first domino because it is smaller and more sensitive. It reacts faster to stress. It swings harder. It reveals instability sooner. Gold is the larger domino behind it. If silver volatility increases because of leveraged pressure in paper contracts, That tension does not stay isolated. It moves through clearing systems, counterparties, and institutions. If exposure is large enough, it forces intervention. And when intervention happens, it tells you something important. The paper structure has grown too big relative to the real metal underneath. But here is what many investors misunderstand. This situation does not automatically mean prices go straight up forever. It also does not guarantee collapse. What it means is instability. Instability creates opportunity, but only for those who understand it. Silver historically moves in powerful bursts. When it breaks out of long-term bases relative to gold, it can surge rapidly over a few quarters, not slowly over years. That is its character. In 1980, silver multiplied within months. In 2010-2011, it doubled within 7 months. Those were not calm markets. They were emotional, volatile, and fast. Today, we are only a short time into what could become another powerful phase. Momentum indicators are turning upward again. Sentiment was crushed during the recent pullback, but structurally, nothing major has broken. In fact, long-term monetary conditions support metals more than ever. Global debt is at record levels. Trust in fiat systems is weakening. Central banks continue accumulating physical gold. That is not speculation. That is strategic positioning. Silver's monetary role is reawakening. For decades, many investors forgot that silver is money. They saw it only as an industrial metal. But history shows that when monetary anxiety rises, silver reclaims its identity. At the same time, speculative bubbles in other assets are deflating. When leveraged assets fall sharply, capital often searches for stability. Precious metals, especially gold and silver, historically absorb that flow. Now let's address something important about gold's technical position. Gold is trading significantly above its 200-day moving average. That distance is rare. It signals tension in the system. But tension does not equal overvaluation. It means markets are stretched. Eventually, they either correct, consolidate sideways, or allow moving averages to catch up. Nothing goes straight up. Nothing goes straight down. Short-term pullbacks should not surprise anyone. They are part of every bull cycle. The question is whether the larger structural shift from paper dominance to physical demand continues. If that transition strengthens, silver could define a new upper range much faster than most expect. But remember this clearly: volatility works both ways. If silver were to surge to extremely high levels very quickly, corrections afterward could also be sharp. That is why positioning and risk management matter. The goal is not emotional chasing. The goal is informed participation. Right now, silver appears to be climbing out of a corrective phase. Momentum is rebuilding. Sentiment is low. Historically, that combination has often preceded strong advances. The financial system feels more fragile than it has in years. Leverage is high. Paper exposure is enormous. When systems are stretched, even small shifts in confidence can trigger large reactions. That is why understanding structure matters more than daily headlines. If the dominoes continue leaning in one direction, the metals market could become the center of global financial attention. And when that happens, price discovery may accelerate dramatically. But we stay grounded. We focus on long-term trends. We recognize volatility as part of the journey. We avoid emotional decisions. If you found this breakdown helpful and want clear, simple analysis about gold and silver without hype, make sure you subscribe to Gold Silver Scope. This channel is dedicated to helping you understand what is really happening in precious metals so you can make smarter decisions with confidence. Turn on notifications so you never miss an update, because in volatile markets, timing and information matter. And before we close, a quick reminder: this content is for educational purposes only. It is not financial advice. Always do your own research and consider your personal financial situation before making investment decisions. Markets carry risk, and volatility can move both up and down. The dominoes are leaning, the volatility is rising, and silver may once again remind the world what it is capable of. I'll see you in the next video on Gold-Silver Scope.